Hey, if you want to learn how to sell put options and start generating some upfront income for yourself and or be able to potentially buy a stock you want at a really cheap price, then you're going to want to learn how to sell put options. It's our bread and butter, what we do here. So if you want to learn how to do this strategy, you're going to want to watch this video. So let's go. All right, everyone, Lee Lowell here from smartoptionseller.com. What we're talking about today is selling put options and generating income. That is our bread and butter. That is what we do here at the Smart Option Seller. Selling put options is our main gig. So I love talking about selling put options, and this is what we're going to focus on today. So let's just jump right in and start talking about what selling put options is all about. As many of you might know, there's only two kinds of options in the options world: call options and put options. And we're only focusing on put options here, and we're focusing on selling put options. You can be a buyer of options or a seller of options. We focus on selling put options. So what is selling a put option? What is it all about? Why are people talking about it? Well, when you sell a put option contract, what you're doing is, in essence, obligating yourself to potentially buy a stock of your choosing at a price of your choosing sometime in the future. And in exchange for your obligation to buy those shares of stock, potentially, you will get paid upfront cash by the put option buyer. So you're entering into a contract to potentially buy some shares at a certain price in the future, and you get paid for that obligation. Now, when you sell put options, and we're going to go over the cheat sheet here. This is our cheat sheet, the Smart Option Seller Guide to Selling Put Options. When you're selling put options, there are two schools of thoughts, or there are two methods of why people sell put options. And 1 and 2 right here. A lot of people will sell put options just to collect the income. They found this newfound cash, a new way to collect money by selling put option contracts because they know they're going to get paid by the put option buyer. And so people want to do that to create an income stream for themselves. And that's totally fine. I do that too. And that's what we do in our newsletters. But it's also a riskier way to sell put options because a lot of people will sell put options on stocks they know nothing about, or they have no interest in potentially buying these shares. They just want to sell put options to collect the income, and they're willing to do it on almost any stock. And that could be very risky because you don't know anything about this company. All right. So, the way we do it is we make sure we only sell put options on quality companies and companies that we would be okay with potentially buying shares of stock, which leads us to thought number 2. The reason why you can sell put options is to potentially buy a stock that you want to buy at a cheaper price than where it's currently trading right now. If the stock's at 100 and you're like, it's too expensive for me at 100. I want to buy that stock cheaper, somewhere down here. Okay. So instead of just putting in a limit buy order in your broker's platform, so if the stock's at 100 and you put in a buy order to buy yourself some shares, if the stock ever comes down to 80, many people will do that. But the thing is that you never know if the stock's going to drop to 80, and the stock could go up and go up without you, and you'll never be involved. But by selling a put option instead, it will still act as like a limit order, a buy limit order at $80 a share. But in the meantime, you're going to get paid some cash up front from the put option buyer for your limit order to buy shares at $80 a share. All right. I hope everyone understands it. So you sell a put option contract at that $80 strike price level, and now you have an obligation to buy the shares just like you would if you put in a limit buy order. But in this case, you're going to get paid some cash up front to potentially buy those shares in the future. Now, if it's your goal to just sell put options to collect the income, let me just tell you a couple tips here. I'm looking right here on the cheat sheet. If you're selling these puts to just collect the income, you want to make sure the stock is in an uptrend, because selling puts is a more bullish, neutral, bullish type of directional trade. So there would be no sense for you to sell put options on a stock if the stock's going downwards. You want to make sure the stock's either flat or going up, because that way you'll make profits faster, okay? And also, you probably want to sell put options with strike prices that are out of the money. Out of the money means the strike prices are below the current price of the stock. So like I said, if the stock's at 100, an $80 put is considered out of the money, okay? So if you're just trying to get the income, make sure you're playing with, more probability on your side, meaning if the stock's in an uptrend, it'll probably keep going up, which is helpful when you sell put options. And you want to use a strike price, as I said, that's out of the money, because if the stock starts to drop a little, you won't get hurt so bad right off the bat. Okay? Now, right here, if you're selling the put options to potentially buy the stock, then all you have to do is figure out, where would you be comfortable buying shares of that stock? Okay? And once you know your level, then you decide which expiration date you should choose. So all options have different expiration dates. So you just have to manually go through the expiration cycles, and I'll show that in a minute. I'll bring up the option chain, and you figure out which month you want to choose. And how it works is that the longer you go out in time in the expiration cycle, the more money you will get paid. So we'll look at a couple different months here, and we'll see what these things are paying. So we're going to use an example here. We're going to use AMD as the stock. We're going to look at the chart, and we're going to look at some option prices, and we're going to see, what we can do. So let's just quickly look at the chart of AMD. I have my chart up here already. Here's AMD. Since the middle of October of 2022, AMD's been in this nice uptrend, and you can, draw yourself a little uptrend line here, connect some of the recent lows, so you know where the stock has some support moving forward. AMD's, finished the session around $107 a share. So let's go back to our cheat sheet here, and we're going to look at the example. And this is an example only. This is not a live recommendation. So with AMD stock currently at $107 a share, in the case where you want to try to buy the stock cheaper, in your mind, you're thinking, $80 a share is a good level that I'd be happy and comfortable potentially buying shares of AMD. Why $80? Well, if we go back to the chart, you can see, the stock's at 107. $80 is all the way down here. It would have to crash below the 200-day moving average. It would have to fall below the uptrending support line. So $80 is a good level in your mind, and 80 is just below this last swing low here. The last low that the stock made, a major low, was just above $80 a share. So you're thinking, what? If AMD can retrace all the way back towards 80, I would be comfortable buying shares of that stock. Okay, so the next thing you need to do is, if you're okay buying shares at 80, now you have to check the option chains to see how much money you will be paid for your obligation to buy shares at $80 a share. And this is where it comes time to look at the option chain. Okay, so here's the option chain from Interactive Brokers. This is a broker that I use. And if you want to get some information about Interactive Brokers, down in the description underneath this video is a link that you can click on to read about Interactive Brokers. Now, I pulled up the AMD chart here, the AMD option chain, and we're looking at the October 2023, October 20th, 2023, expires in 65 days. So we're going to look to see, what we can do, what we can get if we sell these put options. All right. So we're choosing let's quickly look back at the cheat sheet here. All right, so we want to buy shares at 80, so we're going to look at the October $80 put option. Okay, so in the option chain, here's the 80 puts right here for October. They're trading 61-cent bid at 64-cent offer. That's how they went out today. So we want to always try to sell somewhere in the middle of the bid-ask spread. So let's just say we can sell these put options for 62 cents per contract. With the option multiplier, you have to multiply the numbers here by 100 because there's 100 shares in every option contract. So 62 cents times 100 is $62. That's how much money you'll get right up front in your account for selling one contract. You get $62 plopped into your account, and now you're on the hook to potentially buy 100 shares of AMD at $80 a share by October 20th. And the only way that will happen, the only way that you'll have to follow through on your obligation is if AMD actually falls to $80 by October expiration. If it stays above 80, then you're off the hook. You keep your $62, and then you can sell another put option for another expiration date. So if you're looking for October, let's take a look. Let's go out to a longer expiration date here and go to December, for example. And you can see the 65 puts are now worth, the 80 puts is what we were looking at. is worth about $172 or $1.72 per contract, maybe $1.73, somewhere right in the middle. So if you went out to December instead of October, you're going to get $173 instead of $62 because you've lengthened out your expiration by 2 months. As I said, the longer out in time you go, the more money you get. So you just have to decide, how much time I want to give. The more time you give, also, there's more of a chance that the stock could drop. Okay, so that's up to you to decide what you want to do. For us, let's go back to the cheat sheet here. Okay, so you collect your $62 and you're on the hook to buy 100 shares at $80 a share in the future. Now, let's look at what the cost, the break-even / cost basis would be if you actually went through with this trade. Now, since you sell these things for 62 cents a contract, your actual cost basis would be $79.38. And the way that we calculated that is you take the strike price of 80 and you minus out the premium that you collected, the 62 cents. So that's $79.38 if you have to follow through with the trade. That's if AMD falls down to $80 by expiration, okay? And a lot of people want to know, what kind of returns can you see on trades like this? How do you figure out the returns and what are they? So the return on margin is, when you sell a put option, you're not buying anything, so you don't have an investment in the trade. You're selling options, you're collecting money. So what do you have to do to engage in this type of trade? Well, your broker, and depending on the type of account you have, is going to make you keep some money aside while the trade is active. It's called the margin requirement if you have a margin account. And the margin requirement is roughly 20% of what it would cost you to buy the shares at the strike price. So in this case, if you bought 100 shares at $80 a share, that's an $8,000 outlay on expiration if you had to buy your 100 shares. But until expiration occurs, you only have to keep about 20% of that $8,000 on hand in your account, which would be $1,600. Okay, right here. That's $8,000 times 20% is $1,600. So in order to figure out the return on this trade, if the trade expired worthless, if AMD never fell down to 80, you would get to keep your $62, and you divide that into the $1,600 margin requirement. So your return would be 3.875% in the 65 days that the trade was open. And if you annualize that, it's a 21.75% return if you're using a margin account. Now, if you have a cash account or you're using a retirement account to sell put options, then you have to keep the full 100%, the $8,000 on hand at all times. Okay, so your return is actually going to be a lot smaller if you have to keep the $8,000 on hand versus if you had a margin account, you'd only have to keep $1,600 on hand. So that's a big difference. So you need to think about, do I want to sell put options in a cash account or a margin account? And it all depends on if you can get approved for a margin account as well to sell these put options. Okay, so you have to figure that out with your broker. Now, that's what we, typically do in our newsletter is that, we choose a quality stock that's typically in an uptrend and a stock that we would be okay owning in the future. But in our newsletter, we only concentrate on strikes that are $50 and under. The AMD trade, we're looking at the 80 strikes. So that'd be a little bit too high for us. We only look at strikes at $50 and under. And here's our parameters when we sell put options in our newsletter. We always look for the strike price, which is set 20% below the current price of the stock. Okay, so in the case of AMD, if we were using AMD, AMD's at $107 a share, 20% of that would be about $21. Okay, so that would be about the $86 level, 86 strike. But we went down to the 80 strike, so that'd be a little bit more. Even more cushion. So I forgot to mention right here, if you were trying to buy AMD at 80, that'd be a $27 discount from where it currently trades, which is a 25% buffer between the stock price and the strike price. So that's a pretty good discount. If you got to buy your shares at 80, you'd have a nice $27 discount, which is also a 25% discount from its current price. Okay, so what we do in our newsletter, we always look for strike prices at least 20% below the current price of the stock. And we're looking to collect 25 to 30 cents a contract. Very, very, very conservative. Okay, we want to do this because we want to teach our students how to sell put options in a very non-stressful way. We want to have a lot of cushion between the stock price and the strike price just to show how the trades are done. So we go very far out of the money and we get 25 to 30 cents per contract using the shortest expiration date that meets those parameters. And the other thing that we do is we make sure we always make these trades in between earnings announcements. Earnings are given 4 times a year, every 3 months. So we try to make our trades in between those 3 months. Okay. Now, a lot of people want to know, what's the probability of winning? How do you figure that out? Typically for our trades, we'll have, close to at least a 95% probability of profit, meaning the stock won't fall to the strike price. Let me drop that out of there. So the chance of AMD going from 107 all the way down to 80 is, what is the probability of that happening? And that's where you can go to a probability calculator like we have on our website, Smart Option Seller. So I put in the numbers. AMD's at 107. We got 65 days to expiration. The volatility is about 44%. You can also find that number in 2 places, but in a quick, easy way to do that is we go back to October. Right here is the implied volatility is just under 44%. So we put that in the calculator, 44%. We want to see the target of $80 in both target boxes. When we click on go, we have only a 5.8% chance of AMD falling that far. Conversely, there's a 94% chance that AMD will not fall that far in the next 65 days. So what you want to do as a put option seller, you want to have a very high probability that the stock is not going to drop to the strike price because you just want to collect the cash and move on to the next trade. Same thing that we do in the newsletter as well. We want to have a very high probability that the stock's not going to drop to the strike price, even though we would be okay buying shares of that stock. It still costs a lot of money, $8,000. So we would rather not buy the shares of stock. We would rather just have the stock, the option expire worthless and move on to the next trade. So we want to have a really high probability of, in this call, it says finishing above highest target. So there's a 94% chance that AMD will finish above $80 a share. Okay, so we go back to the cheat sheet here. Let's just go over a quick couple items here. As I said, you'll need to keep money aside, which is basically what you can call collateral while the trade is open. That's called the margin requirement. Whether you're using a cash account or a margin account, you're going to have some money that needs to be held aside because your broker needs to know that you'll have some skin in the game, because if you end up having to buy the shares, they need to know that you're good for the money if you end up having to buy the shares. Using a margin account, you only have to put up that, hold aside that $1,600. If you're using a cash account, you have to hold aside at least $8,000. All right. So just keep that in mind. Also, risk management. We want to talk about risk management because not all trades work out. If you're in this just to sell the put option to collect the cash, you can always buy the put option back at any time you want. If the stock starts to drop on you and you're like, you know what, I think this stock's really going to keep dropping, then it's probably in your best interest to buy that put option back to cut your losses. So you buy that same put option back that you originally sold, and you pay whatever the going rate is for that put option at the time. And that may end up being a profit or a loss when you eventually buy it back. So then the obligation will be gone and the trade will end, okay? Also, you can roll the trade. So if we originally sold the put option at 80, we can buy that 80 strike back, but then we can sell a 65 strike at a further out expiration date, okay? So let's go back to the option chain real quick. So if we had to, let's just say we had to buy these put options back at 107, we can go out to December and go down to wait for the money to roll in here. So we can actually roll down to the 75 strike and sell a new put option for about $1.14 per contract. Okay. So let's take a quick look. Where were we here for a second? We were looking at the 8 puts, so I was looking at the 85 puts. So if we had to buy the 80 puts back at, let's say 64 cents a contract, we'll make it even. We'll go back to the December. we want to sell something, a new contract, for at least the same amount that we had to pay to buy the original one back. So in this case, we can go down to at least the 70 puts and get 74.75 cents for it, which would offset the cost of the original one. And now you just lowered your strikes by $10 a share from the 80 to 70. So that's what's called rolling the put options. All right. So there you go with that. Let's get that out of the way and go back to the cheat sheet here. All right, so that's basically the way that you sell put options, and the two ways to do it. Number one, you're either there to sell puts and collect income. If that's your thing, then you want to make sure, like I said, make sure the stock's in an uptrend. Make sure you know something about the stock and use some of these added money strikes so you don't get hit with a big downdraft unexpectedly in the stock. If you're there to potentially buy the stock at a lower price because you actually want to buy shares of that stock at a lower price, then just be comfortable with the level that you can potentially buy those shares at, and pick the expiration date that you want to choose and see how much money you'll get. Go through the expiration dates and see how much money you'll get. All right. And you can also check a probability calculator to see what your chances are of winning. Now, if we go to our website, smartoptionseller.com, click on the Put Selling Basics link right here. We're all about selling put options. This is our free ebook. If you don't know what put selling is all about, even after watching this video, get our ebook. Okay, scroll down here, fill out the form, email address, name. We'll send you an email back with a link to download the free copy. This form is all over our website on all these other pages. You only have to fill it out once. Okay, if you want to learn a little bit more about what we do, here's our services tab. We have our newsletters. We sell put options. We sell put option credit spreads. We have our coaching sessions as well to help you up your game if you need a little help there. We also have the calculator purchase if you want to buy the probability calculator. All right, so that's it in a nutshell. Down in the description below, there's some links for you that may be helpful. I've got some books on how to do some technical analysis, the Interactive Brokers link, some other websites that may be helpful to you. What you're going to see on the screen here is a couple other videos that I've made in the past about put option selling. Watch those. It's all free here. I'm just trying to help the community, give you some knowledge from the 30 plus years I've been in this business. All right, so give me a like, give me a thumbs up, leave me a comment, send me an email. I will always answer your emails. All right, so good luck, everybody. And this is Lee Lowell, and I'll see you in the next video.